I can't time the market. I don't understand all those risks. I know there's a risk an asteroid will hit the Earth. So when will that happen? I don't know. Is it an if? It's not an if, it's a when. It will happen.
Shorter term, what does the trajectory of Bitcoin look like to you this year? So about this possible winter, are you really not feeling the cold? So about this possible winter, are you really not feeling the cold?
Look, if you're going to invest in Bitcoin, a short time horizon is 4 years, a mid-time horizon is 10 years. The right time horizon is forever. Warren Buffett said, if you wouldn't hold it for 10 years, you shouldn't hold it for 10 minutes. If you look at the course of 4 years, no one's ever lost money over 4 years holding Bitcoin. And if you look at our experience, we started buying it at $10,000. Now it's up by a factor of 4. So given the right time horizon, you're fine. So it's a blessing and a curse. The blessing is it makes it the most exciting, interesting thing in the financial universe everywhere in the world. And the curse is it can induce anxiety for people that have a short attention span or are focused on a narrow time horizon.
What do you think then is behind this early 2022 crash?
I think that there's a lot of dynamics here. If you look at the entire crypto ecosystem, you have a set of regulatory uncertainty, especially regulatory uncertainty around stable coins and crypto tokens and whether or not they're securities. And that creates a little bit of anxiety. You have a lot of leverage offshore. Right? You have a lot of crypto exchanges that can trade with up to 20x leverage. And those crypto exchanges have many, many tokens that are cross-collateralized. And between them and the DeFi exchanges, you can get much higher than 20x leverage. So that's a second source of volatility. The crypto markets are almost designed to encourage volatility. And that creates kind of a love-hate relationship between the crypto ecosystem and the Bitcoin hodlers. The Bitcoin hodlers are holding for, a decade and sometimes for 100 years and sometimes for 1,000 years. And yet you've got fast money hedge funds that have a tax incentive, a huge amount of leverage and massive volatility. But you have two totally different investment mentalities here. And when they come together, the result is you've got, in my opinion, the world's least risky asset to hold over the next century called Bitcoin. And you've got the world's most volatile, fast money market, called crypto.
So when will that happen? I don't know. Is it an if? It's not an if, it's a when. It will happen because I can't really imagine that we live in a world where 30,000 people don't want billions of dollars of money. Sometimes I'll talk to these big investors and they'll say, what's this thing with Bitcoin? I say, it's digital properties, the dominant global digital asset network, and it's a lever. Here's the reason it's better than credit or bonds or real estate. Here's how it fits in your portfolio. And they're like, I gotta think about it some more. And I try to always be very polite, but in the back of my head, you have $25 billion in your portfolio and you generated 2% yield last year, which is downright embarrassing because the S&P was up 25% and a freaking robot could have got 10x what you got. And I'm thinking, you must not like money that much. I stay out of that just because I'm not here to give you trading advice. I can't time the market. I don't understand all those risks. I know there's a risk an asteroid will hit the Earth. And I know there's a black swan risk and maybe, demons come down from hell above or heaven below or whatever, and they screw with Bitcoin. I get it. But all things considered, you're going to lose 90% of, your money over the next 24 months if you're in a hyperinflating environment by doing nothing. So my view is if you're guaranteed to lose 90% of your assets to do nothing, then, you might as well do something. And it's like I said to people on Bitcoin, it's like, you don't like Bitcoin? You think it's 95% likely to fail? Okay, then only allocate 5% of your money to it. If you think it's 99% likely to fail, then you might as well put 1% of your money in it, right? So I think that people oftentimes, they don't get their risk right. There is a risk to doing nothing. And the risk to doing nothing in a monetary sense is the monetary inflation rate. So when the monetary inflation rate hits 25%, it means that there needs to be a 25% chance of Bitcoin going to zero in the next 12 months for you not to want to buy it. And when the monetary inflation rate hits, in Lebanon or Turkey or Argentina or someplace, when it hits 50 or 75 or 80 or 150%, the risk of doing nothing is far higher than the risk of doing something.
I feel like it's consolidating at this level. This is a great entry point for institutional investors. I talk to high net worth individuals, family offices, public company executives, private company owners, and they watch Bitcoin run up in 2021. And there are a lot of people that would be afraid to own it if it was going up 400% a year. But if they're staring at it and it's 40% off the all-time high and it's consolidating, and they see that it's being embraced by people like Bill Miller, by very well-respected investors, it's being embraced by the regulators, it's being embraced by senators and congressmen and public investors and public companies. They're looking at this as like a good entry point, which is what's really going on here at a macro level is inflation. The CPI headline inflation is 7%. Look at the Turkish lira. It's collapsing. The peso is collapsing. So there's a volatility story for a conventional investor in Manhattan that's got a portfolio of equity. But 75% of the world can't buy the S&P index. They're in Africa, Asia, South America. And if they've got their assets in banks, they're going to have them seized. They can't buy the equity. So the real story here is digital property that solves a problem that 8 billion people face.
The big question is then, are you going to buy more? Yes or no?
Yeah, we're going to buy more. We're buying more with our cash flows. We've adopted a Bitcoin standard, Emily, that when we generate cash, we sweep it into Bitcoin. We've been generating, anywhere from 70 to $100 million of cash flow. So we will also buy Bitcoin with debt. We bought Bitcoin with $1.7 billion worth of convertible debt. We bought Bitcoin with a $500 million senior secured note that we pay 6 1/8% interest on. We also issued $1 billion worth of equity at the market, and we converted it all into Bitcoin.
We're an institution, so the life expectancy of an institution is forever. If you're a company, right, the company will transcend, it will last past me, right? I'm not a family, right? The life expectancy of a family depends upon the family. It might be 100 years, it might be 10 years, right? It might be you're a solo dude and you're thinking, I just need to have a Lambo in 3 years and nothing else matters but a Lambo or whatever. Institutions have a longer time horizon. The second is we're a profitable institution. If you're an individual and you were trading in crypto and you needed to pay your bills and you worried about health insurance, or you got married and you had kids and you want to put your kids in, you want to get a house or buy a car, well, you have near-term cash requirements. MicroStrategy generates cash. When we came down this path, we concluded we would always generate cash. And the reason we concluded this, Kobe, is there's a massive digital transformation, and we realized that no amount of throwing money at sales and marketing will actually grow our business. We couldn't throw money at it if we wanted to. We tried it. It's advantageous to be in business 30 years. I've gone through a period where I'm going to hire 400 engineers. I'm going to go spend $20 million on marketing trade shows. I spent $20 million on ads on Facebook and LinkedIn. I've spent $500,000 for 2 days of a trade show. I've been there, I've done all that stuff. I got to the point where I realized that we really couldn't throw money and capital at the core business and make it grow. We had a cash cow. And the problem with a cash cow, by the way, is if the money supply is expanding at 10% a year, which is what it was from 2010 to 2020, if your top line and your cash flows don't grow more than 10% a year, your stock will tank. So the only way to avoid your stock tanking, if you want your stock to be a store of value, you have to grow your cash flow per share greater than the rate of the monetary inflation. This is why Amazon works. Amazon, Google, Facebook grow 20%. That's why they work. This is why Apple bought a lot of their stock back and leveraged up, right? If you can't grow your top line, you either do acquisitions. This is why Oracle bought a lot of companies. Your choices are you have a monopoly and you grow your top line 20%, or you do a bunch of acquisitions, or you leverage up, or you sell out. Those are your 4 choices. So imagine if I can't grow 20%, I got a problem. But what happens when the inflation rate goes to 20% and you can't grow 30%? Okay, at that point, it's pretty hopeless. So I kind of realized that I had a good business, but as a public company, it's dead money because the investor's view is they want you to grow faster than the hurdle rate, or they just rather you roll over and die. If your father or mother was a doctor and they had a practice and they were doing good business and delivering babies babies and saving lives, and the inflation rate's 25%, and you said, Mom, Dad, are you going to raise your prices 25% this year? Like, no, my customers can't pay 25% more. Okay, so roll over and die. Like, what? So I got to like roll up the business? And like, there's something in our society, right, where I think it's pretty obvious that you probably need doctors and dentists, even if they can't grow their companies 25%. You need them. But somehow in the public market, the public investors are of the view that if your company can't grow 25%, you're worthless. And so there's a dichotomy. And you can see that if the central bankers crank up the inflation rate from 3% to 7% to 10% to 15% to 20%, what you're doing is you're tilting the playing field in favor of the monopolies and the manufacturing businesses against the small businesses and the manufacturers and the craftsmen. And eventually you're just destroying anybody that's not highly automated and highly capital intensive. And I saw it viscerally. 99% of my competitors went out of business. Well, I am literally the last man standing in my industry.